Good morning. My name is Brian Wagner. I'm the Chief Architect of Prodigio RTS. And today we have a great chat where we're going to talk about how you can create breakout strategies in Prodigio. Specifically, the one that I'm going to look at today is something called a consolidation breakout strategy. Now, a little bit about what this is. Well, first of all, Prodigio. Prodigio is the automated trading system that's available exclusively by thinkorswim and TD Ameritrade. And what it is a system that launches from the thinkorswim platform. After your permission for the system, you launch it. It runs in a separate application, and it is a suite of trading automation tools. There is a million and one things that you can do with the system today, but we are constantly adding to the system, and we have a really big build that we're working on, which is just going to add several more dimensions about what you can do with the system. If you have questions about Prodigio, send those questions into prodigio@thinkorswim.com. And of course, to request activation, send an email into support@thinkorswim.com with the subject line Prodigio activation. Make sure you give them your username and your account number, and they'll get you activated right away. Follow us on Twitter, twitter.com/wizardlab, and join us on our home on the web, prodigiorts.net. There's the forum there, and you can follow the blog entries and any strategy that I build during these chats. If it is a strategy that has some substance to it, I post it out on the blog, and you can import-export into WizardLab using our import and export tools. So I want to get started with this strategy. Consolidation breakout. The idea here is that you want to catch wind of a brand new trend. And I was looking at just some recent price activity, and I came across this chart on ExxonMobil. And this is a great example, especially if you look back over the past couple of months. There's many instances where the price direction kind of breaks out of stagnation. If I were just to eye this up really quick, it kind of happens around here. It plausibly happens again around here, and then here and here, etc. Because it was going up. Then there's the recent market momentum, which reverses direction. Here at the end of July, the beginning of August, and it kind of breaks down, etc. This is just an example, but the idea is you have price action on a tradable instrument. The price action is either going sideways or it is behaving in kind of a mediocre fashion. Then all of a sudden there is a strong change in direction or strong confirmation of direction. There's a strong movement either to the upside or the downside. This is extremely relevant to trading because there is a crazy amount of profit potential when things move in a wide direction over a sustained period of time. This is obviously, you make your money on the moves, and especially if you're swing trading or position trading, if you hold these positions during these trends, if you can identify them early enough, this is probably how you capture the majority of your profits. There's different philosophies towards plays on the market. You're going to invest in things that are backed by things that have sound financials and sound economics. Those are the companies you're going to invest in. But when you're swing trading and you're looking to kind of capture profits and gains that exceed the possibilities of investing, by managing your portfolio, etc., the best thing that you can look for is a play that's going to last over a couple days. It's going to sustain, and it's going to move in a large direction. If you had been short, for example, at say the high price of this XOM, which was somewhere around 85.41, if you rode this all the way down, this went as low as 67.03. And if you just rough estimate that, that's 80 down to 60, that's somewhere around a 23% return on that investment. I mean, should you capture this this downward movement perfectly, that would be a 23% return on investment. Now, obviously, these exceed the amounts of returns that you're going to get by investing long term, especially in an economy like this where there's a lot of plays to the downside, etc. So the concept of this consolidation breakout strategy is we're looking for plays that have strong movement in either direction. And I'm going to give you the tools that you can use with respect to technical analysis and Wizard Lab so that you can automate these strategies in order to set up a system that can automatically identify opportunities where this happens. So I'm looking at this chart on XOM here, and there's a bunch of different philosophies about how you can scan for breakout. There are the basic philosophies that compare ranges of price. So it looks at highest high, lowest low. And just as a tip, if you want kind of highest high, lowest low analysis, there's a great study called Donchian channels. Let's see, here's Donchian channel width. Here's Donchian channels. All this is, and I'll kind of change the color just so you can see this really quick. All the Donchian channels are, and I only changed the upper channels. Let me change the lower band. Let me also make that a thick white line. All Donchian channels are channels of highest high and lowest low offset by one period. That's really all they are. This is really great to use if you are looking for ranges of price. And of course you can expand the window. This is looking back over 20 periods, etc. If I make this wider than 20 periods, the bands are going to get kind of fatter. Right? See how they kind of get fatter because the highest high over the last 50 periods, it kind of stays the same until it's breached. Now you can create breakout strategies using the Donchian channels, but I'm not going to focus on that one. I'm going to use what I consider to be a slightly more sophisticated approach, which is just as easy to use in Wizard Lab. And the approach that I'm going to focus on is a combination of Bollinger Bands in order to find the breakout or breakdown conditions combined with a volatility measurement of average true range. Now I'm doing this combination for several reasons. Number one, Bollinger Bands. What those are bands of volatility. And the way that you set up Bollinger Bands as a study is that you have a period, and that period defines the number of smoothing periods for a moving average. Right? Now, moving average is nothing more than add up all the price values and divide by the count of price values. It's just an average of the prices. If you create an average of these prices, which I will highlight here by making a thicker line, this middle band, it's just the average price. And we use this to kind of give ourselves a rule of thumb measurement about how much the security is worth, relatively speaking. The price moves every day. You know, it moves during the day, it moves a lot, and it moves around. But the moving average, all that gives us is really like a rule of thumb. And it says, well, you know, XOM right now, it's worth about, about $75.61. And right now it's trading a little bit below that. So if I was looking to invest in ExxonMobil, it would be a great time to buy this stock right now because it's below its moving average, and it's kind of has some support down here with the recent down move, etc., etc. I would take all of these things into consideration of my decision, and one of those things that I take into consideration is the moving average. So the moving average, it's very simple, almost too simple concept to use by itself. But what the Bollinger Band does is it adds to that. Right? It adds to that by creating these channels which have bands above and below the average price. Right? So exactly, yeah, the price is somewhere around 72. What's that price right now? 72.91, something like that. And this is an exponential moving average. Okay, my exponential moving average is 72.91. Right? So the price right now is around 72.20, right? So it's 70 cents below that moving average. These bands are a measurement of volatility, right? So what they're trying to do is they're trying to give you a range of price action relative to that average. So it's saying generally more or less if the average is this middle range, you can expect the price to kind of oscillate inside of this range. And that's generally true in a lot of cases. You'll see during this time period, I have a Bollinger Band offset of 2. And I'll explain specifically what that is. But this offset of 2 makes these bands a little bit loose, a little bit wide. And what that does is it allows more of the price action to fit inside of this band. So I've got a channel, based on, the average and volatility, and I'm just wrapping that average with its volatility range, and that's what a Bollinger Band is. That's all it is. So the price action, sometimes it's in the upper part as it is here, and then sometimes it's in the lower part as it is here. Now this range, it's really just giving you another rule of thumb so that you can compare the price action against its volatility range. And what happens sometimes, and this is the key to this strategy, is that sometimes the price action exceeds the range of volatility. That's significant because what it's saying is that the momentum in one direction is strong enough to break out of its normal price action. And that's the key to this breakout strategy. When I have this band, and when the price action begins to dip, and the first time it dips is at this bar right here. If I hover over and look at the prices, the low of this daily bar was 79.76. That actually broke below Bollinger Band down, 79.83. Right, so the band was up at 83, and the price dipped below 83 all the way down to 76. This can be perceived as a signal that something significant is happening. And if you are looking for a downward play, this is a good signal based on a fundamental change in momentum. Now we're going to combine this, right? Because you tend to get a lot of fake out signals. If you just use Bollinger Band by itself, what happens is things happen and they're not necessarily a breakout and they're not necessarily a breakdown. We're going to attempt to create a system that lets you tweak the filtration of whether or not something is a fake out or not. Right? I'm going to demonstrate how to do that. In this system, let's see, I believe this movement down here would possibly get filtered out, and it would say this is not really a breakout, but this is. And if I just eye this up, there's a significant difference between this movement and this movement. If I draw lines on here, and I create just a very simple, I just want to make a trend line. Right? This trend that I'm drawing right here, and let me make that a little bit thicker. This trend has a much steeper slope than this trend that I'm going to draw here, which is still a downward trend, but relatively speaking, the one's a lot steeper than the other one is. Right? So there is a difference between this slope, and that difference can be controlled by understanding the technical analysis. So a lot of people try to do things with angles. You don't really need to do that. That's actually probably thinking too hard about it. You can create a system it's much easier to tweak, and you don't have to worry about trigonometry or angles or anything like that. Angles are, by the way, angles are a function of the range of your chart. And if I pinch the range of the chart, see these angles all change? This yellow line is a lot flatter than it used to be. Right? So just beware of angles. They're usually not the best thing to look at. So I'm going to remove these off my chart. And we're going to use Bollinger Bands, and specifically the volatility range. The way that that's calculated in a Bollinger Band is by measuring something called a standard deviation. All a standard deviation is it's a math formula that measures how often things are distant from the mean, distant from its average. And you can look this up online. You can look this up in any statistics book, any probability book. People who play cards, right, a lot, and they know a lot about, let's say, a Texas Hold'em or something like that. They live and breathe by standard deviations, expected values, probabilities, etc. Some of these studies in technical analysis do the same thing. So just as the Texas Hold'em professional understands that there's a difference in hands, or understands that there's a difference in the cards yet to be played versus the cards that have already been played, these are the same exact techniques, just presented in a different way. And Bollinger Bands uses one of those techniques called the standard deviation. And it's a very de facto standard way of measuring volatility in mathematics. So this is used all over the place, in physics and anything based on probability, anything based on measuring events in an event space, etc. Well, it's just built right into the Bollinger Band, so it's a really good volatility measure. Now, you can use standard deviation by itself, but I am going to pair that with an average true range. Right? Now, let me explain the reasoning behind the ATR. The ATR, that's another one of these classic Wells-Wilder studies that was developed in order to measure volatility. Now, the secret here between understanding, well, why do so many people use the average true range? Why doesn't everybody just use standard deviation? There's a couple reasons, and I'm going to focus on two of them. Number one of the more important reasons is that they're two different measurements. They're similar in what they're trying to do, but they are two different measurements. The standard deviation measures the intrinsic deltas, that we refer to these as deltas, but they're differences. The differences between price points. Right? What that means is, it takes this close price and it subtracts it from this close price. And, we'll just take that difference, and we won't care if one's above the other. We'll just take an absolute value of that. We'll just find whatever this distance is, and we'll compare it against this distance. We'll compare it against this distance. We'll compare it against this distance, etc. We're going to use those differences and compare those against the mean. We're going to find out how far away things are from the mean. It's going to tell you how shaky price action is with respect to this middle band here in the mean. ATR is a little bit different. It's actually measuring the high price of the day. In this case, I'm looking at daily bars. By the way, this strategy focuses on daily bars because you're going to get the highest quality signals for breakout strategies by looking at daily bars. And I'm going to explain in the Wizard Lab rule how you can manipulate that. You can look at intraday bars too. You're going to want to use the forming bar study, the forming bar option actually. Average true range, it's measuring not different distances in the price points from the mean, but it's actually measuring the size themselves of the bars. And that's significant because I could look at this bar right here, this big red bar. This was on August the 8th. And its high was 73.44, its low was 69.90. That's $4, or maybe it's closer to $3.50 of price movement during that day. And that's really, really, really significant. Something was going on during this period. As we all know, there was a lot going on. But the size of this bar is relevant information versus a day like this, which is, it's not quite a doji, it's almost like a mini hammer here. This is on the 6th of July, where the price action was only about 79 cents to 81 cents. That's 81 actually, 81 cents. So 81 cents is a lot different than $3.50. Those values are going to manifest themselves differently in different studies, and the ATR, average true range, is going to be affected more by the size of the bar than the relationship of the bars inside of its channel. And so that's why I'm combining these two together, because I'm going to create a system that looks at multiple views of what's going on, and I'm going to create something that I can tweak and control to give me signals specifying where these breakouts happen. So let's look at the details of average true range. As I mentioned, average true range is measuring the size of these bars. Now it's got one more tweak inside of it, right? The other tweak is that it's going to consider the close price of the prior day. And Wilder did this so that he could measure the volatility based on gaps. Right? So you see there's a little gap here between June 22nd and June 23rd. And this gap is actually incorporated into the ATR. And you can see that manifest itself. Right? Look what happens. with this thick orange line, orangish yellowish line right here, the ATR bumps up quite significantly. Well, that bump was caused by this gap in the price action. And what's very interesting is that this bump, which is measured by the gap, which is taken into consideration when we look at true range values, that makes a difference here on the ATR. It doesn't really affect the Bollinger Band that I have set up at all. And that's the difference that I'm talking about. If you look at these in two different perspectives, you gain insight into things differently, right? So this might not be enough to indicate that there's a change in the breakout, but it might be enough to say, well, the ATR is a little bit too volatile. I don't know if I want to consider that movement to be a breakout or a breakdown. Now, one other study that I have up here is I have an average here, which on Chart Trader Pro, if you go into your studies and if you pull up the average true range study, as I have done over here, if I hover over the average true range and I click on it, it brings up my editor so I can edit the studies. And you can add a couple simple indicators on top of the average true range. And what I did was I added a simple moving average. Right, and see, I already done that, so I created two. So let me delete the second one. And you can specify the length of this moving average. You can change the line style so you get this nice chart. It's like a nice dashed dotted line, thick red line. And what I will be doing is I will be comparing a 5-period average true range against its 20-period simple moving average. Now, the reason why I'm doing this is because I mentioned before that moving averages, you should use these as rules of thumb. You shouldn't always buy because price crosses above a moving average or sell because price crosses below a moving average. You get a lot of, they call it whipsaw effects. Right? So what happens is, consider this for a second. If I took this Bollinger Band strategy, and if I bought every time it crossed above this middle band, this exponential moving average, which the EMA, by the way, I can tweak that right here. You see that? I just click on the study, right, and I can change the moving average type, simple, weighted, exponential, or the Wilder average. I'm using exponential for this strategy. If I were to buy every time it crossed above, it would buy it here, which may be a good play. It might not be. It would sell it here, but then you would get the fake outs. You see this high price? That might have crossed it. Let's see. Yeah, it would have bought right here. See that high price of 81.85? That 81.87. I'm sorry. 81.87 is above 81.78, the average. So you don't want something as simple as just buy when it crosses above the average, sell when it crosses below. You need a little bit more, right? And one of the purposes of these chats is to explain how easy Wizard Lab makes it available so that you can kind of add these things together. So the thing that I'm adding here is some volatility analysis, and I'm going to use ATR as a different perspective of volatility, but I am also going to compare the ATR against a rule of thumb measurement, which we kind of call a heuristic, by putting a 20-period average on that. Right? So I don't care what amount of technical analysis you do. This system that I have in front of you is very simple. Right? It's a Bollinger Band and an ATR. And the only extra thing that I have is, well, I have an average on top of the ATR. Now, you'll be able to tweak this and add more, or remove from, or do anything with the strategy. But this is the foundation for which we're going to scan for breakouts. And now I'm going to show you how to build this in Wizard Lab. So remember those three parts: Bollinger Band, an average true range, and a moving average of the average true range. So let's click over on our Wizard Lab tab. Now, Wizard Lab allows you to create strategies by building rules that end in signals. And the way that we work with Wizard Lab is we have a drag and drop user interface, which gives you a no coding required way to kind of set up all of this logic. And I cover this pretty much in every single chat that I do. I kind of talk about how easy it is to build rules, because what this does is it takes away the fact that in something else you would need a scripting language in order to put all of these things together. Right now, this is a free-form logical editor, right? So it's not just a bunch of a lot of other places will try to like get away with giving you, say, 10 drop downs. Like, oh yeah, I can have 10 drop downs and look at like 10 different things, and make a scanning system that looks at these 10 things, and et cetera, et cetera. The rule builder is a free-form editor, which you're basically programming something without programming anything. That's really the concept here. And anything that you would be able to do in a scripting language, you could create a rule that would be able to do the same thing. So what I'm going to do is show you how to build this rule using the drag and drop components of these studies in a Wizard Lab rule builder. And just really quick for orientation purposes, your Wizard Lab tab, it's a 4-step process. There's 4 steps down here, 1, 2, 3, and 4, and they just guide you through the process of building a Wizard Lab strategy. And the ultimate goal for a Wizard Lab strategy is you're going to deploy this for auto trading. There's 2 types of automation. There's semi-automation, which is a screener in trade optics, where you really, well, it's more of a scanner actually, where all of your signals will come into the trade optics, and as I get signals, I can say click on this, and it kind of shows me where the signal happened. Then I can trade it because it's auto-loaded into the order management. Or instead of deploying into trade optics, I can deploy into RTS strategies, and that's going to auto-trade based on my signals. So here I've got a paper money account that's been auto trading some strategies from long ago, etc. So it's managing this day to day, and it's paper money, so I'm not really watching it too much. So that's the gist of Wizard Lab, and we're going to build this Bollinger Band strategy. So this breakout strategy, rather, it starts with a Bollinger Band. So the idea behind building rules in Wizard Lab is that it's a logical flow of information. Just like when you would program something or code something, you have to kind of instruct the computer what to do. You have to say, okay, I want you to do this, I want you to do that, blah, 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 blah. Well, we're going to start from a chart. We're going to look at a chart, and actually I want to go back to my XOM on the daily. And based on working with the chart, we're going to build a rule that does what we want the signals to find on the chart using those 3 parts. So we're going to start with OHLC data. All of these rules, they start with source data. And that's simply saying, okay, you need a starting point whenever you build any kind of rule or strategy or anything, or script or whatever. And I'm going to start with this starting point, which in this case is OHLC data. That aligns 1-to-1 with these OHLC bars. Right? So, I mean, if I have a blank chart with no studies on it, right? This information, it's kind of raw. I don't have any studies. There's not a whole lot happening, especially if I, double click to expand the panel. And yeah, there's volume, but it's just a bunch of, bars with price action. It only gets interesting when you start to analyze the price action. You draw support and resistance lines, or you put technical analysis studies on it. Then that's when you end up with something that looks, like our other Chart Trader Pro, where we're starting to develop our strategy. All right, so we've got these different technical analysis indicators on here. And we're going to start with that raw chart, and we're going to build on top of that the technical analysis. So the OHLC represents data coming into the system. It represents that raw chart. And the way that we add a study is we go down on our left-hand side. See, I have a toolbox here for technical analysis studies. All of the technical analysis studies that are available in the system are listed here in my panel. And I can go down and drag out, these are listed alphabetically. I can take a Bollinger Band, and I mentioned before, this strategy is going to use the EMA. EMA stands for exponential moving average. And all that is a different way of averaging the data. The difference is very simple. It places more importance on the more recent data. Right, so I want you to take a look at this. I want you to take a look at this middle band here, and watch what happens when the price action goes down. You see how this average, it follows the price as it goes down, right? Because the average is becoming lower and lower. Watch what happens when I change it to a simple moving average. I change it to simple, I hit done, and well, it's a little harder to see because of the volatility movement, but the price does not follow, the average does not follow the price as soon. It takes a longer time for the average to catch up with the price. And let me illustrate by, you see how the low price here of this bar, this hammer, that low price is 67.03. The average is 80.31. Right, so remember that number, 80.31. 80.31. I change this back to an exponential, and instead of being at 80.31, it's down at 78.40. The average is closer to that low price because exponential moving averages, they consider the more recent bars to be more important than the older bars. And all you get is something that follows the price action more closely. I'm using that for the Bollinger Bands because I want to identify the breakout at an early stage in the game. Right? I want to identify it, say here as opposed to here, because that's where you're going to capture a lot of your price potential movement for, say a position or something like that. So I'll use the Bollinger Band EMA, and I'm going to send the OHLC output into the input of the Bollinger Band study. And that's it. That's how the rule builder works. You just drag and drop these things together. You literally connect the dots, and the way that you connect the dots implies the logic of the rule. I want to make sure my parameters match. So I have a 20-period Bollinger Band with 2-period offsets. So over in Wizard Lab, I'll change the periods of the Bollinger Band EMA to 20, and I'll make sure that my multiplier, which represents the offsets, is 2. So this right here is going to give me my Bollinger Band. Now, as I mentioned before, we're going to look for opportunities where the price breaks above and breaks below these Bollinger Band points. And so what I'll do is I'm going to create two different strategies. I'm going to create a strategy that looks for long opportunities and a strategy that looks for short opportunities. And the reason why I'm breaking this into two strategies is so that when I build a strategy in the strategy builder, this specifies a trading side to buy or sell the stock. And the reason why we separate the two is because more often than not, you want to do two different things when you go long versus going short a position. And these things run the gamut of, I usually give my RSI example, but they run the gamut of having different logic for long positions versus short positions. For example, RSI values crossing above 30. Well, the opposite of that should be RSI crossing below 70, not RSI crossing below 30. Right? So you usually have different logic in your rules for scanning conditions or managing conditions or whatever. And you also sometimes want to put your trailing stop offsets, your target prices, etc., at different thresholds for long positions versus short positions. So I'm going to focus on first the long signal. Then I'm going to create a strategy that focuses on the short signal. And it's very easy to make the two. Right? So I'm going to look for the price for my long signals, and let's find a good example actually. Let's see, a good example, a very, very good example, is either here or here. Right? And this is a little bit more illustrative, so let's take a look at this. I'm going to look for the price of this OHLC bar to breach the upper band. Right? And this is going to be my basic trigger for the rule. The way I can do this is I can just take the high price of this OHLC and I can set up a logical condition in the rule builder to say, tell me when the high price crosses above the upper band. So I can go into my source data, pull out a daily OHLC, and we have a series of adapters. Right? An adapter is just another way to interpret the data. By default, OHLC studies are going to give you the close price, right? And this close price That's the default on pretty much any charting package that you see. When you just add a study, it's going to be running that study on all of the closed prices. So I'm going to use the high adapter here. And what the high adapter is, and these descriptions are very useful, they're very brief, but they're very useful, returns the high price of an OHLC. If I drag this out and I connect them, this output now gives me the high prices instead of the close prices. So I can use that in anything. I can use that in another study. I can use this in comparative logic, etc. And the logic that I'm going to use from my logical operators is for a cross above condition. Now there's a lot of logical operators, and there's a lot of other videos where we kind of break these down in detail and discuss the semantics of each one of these operators. But for now, I'm just going to illustrate how you can make this strategy, because it's a very interesting strategy because of the way you can tweak it. Right, so I'm going to say, tell me when the high price crosses above, now the Bollinger Band. In order to use a band study, and we've covered this in prior videos, in order to use a band study, we have some more adapters. And for this strategy, you'll want to use the upper adapter and the lower adapter. Now the upper adapter, when I look at a Bollinger Band, take a look at this chart really quick. This is one study. Bollinger Bands is one study, but you've got 3 different parts to this study. And if I click on this editor here, you see this indicator? It lets me pick the moving average, the Bollinger up, or the Bollinger down. These are 3 different parts to the same study. And the idea behind adapter is that's how you would define, using a drag and drop interface, which one of those 3 to use. So any study that's a band like this, Keltner channels, Donchian channels, you can use these upper and lower adapters to pick which one that you want to use. The bands by default are going to give you the middle band, and if you want the upper band, you specify upper. If you want the lower band, you specify lower. So here I'm using an upper adapter. And what these 3 nodes are doing is very simple. It's saying, take OHLC daily values, calculate the Bollinger Band EMA study on top of them, and use the upper value. If I take this and send this into input B, I've now got a rule which is going to fire signals when the high price crosses above the upper Bollinger Band. And it's that simple to kind of define how this system should be producing signals. You can see that this is producing signals by these icons here. Each one of these studies has a system of icons which indicate the value type that it's working with. So when you see this TF, that really means true, false. That's really like a signal. It's answering a yes or no question, true or false. And these are important because you have to match like icons to like icons. So some of these studies, for example, it only makes sense to ask a question where you're getting a yes or no answer. For example, right? If I have an AND study, it only makes sense to use AND if I am combining 2 different questions. Right? So it's only going to make sense if I say, okay, input A is true and input B is true. That's how an AND study works. Well, that only makes sense if you're sending in 2 different signals. Right? So you don't have to worry about all the details of all these. They're built into the type system of the Wizard Lab Rule Builder. Here's one greater than. Greater than has these kind of variable conditions. And what will happen is if I put a study in here, like OHLC, OHLC is producing numerical output. Right? So when I connect this to a greater than study, it says, okay, well, input A is numerical input. Input B also has to be numerical input. The system guides you in the right direction. It doesn't let you do things the wrong way. Right? See, I can't snap this here because it doesn't make sense for me to do that. You don't have to worry about what's right and what's wrong. The system will walk you through in the right direction. But that's really how that's set up, just for anybody who's curious or inquisitive about it. If you're asking about prior day movements, about comparisons, we're actually going to use the forming bar parameter in the ending signal. And I'm going to get to that, but I'll explain the difference between what that means actually. So we're going to be running these studies during the day, and we're going to be using the forming bar. But for now, it's enough to know that this cross above study will give me signals when I rise above that upper band. Now I mentioned that this strategy is going to have another part. And this part is going to be a little bit sophisticated. Very simple to create, but a little bit sophisticated. And here's the way that I'm going to do this. I'm going to look at my average true range, my 5-period average true range. And I'm going to compare it against the 20-period moving average of it. But there's a little secret, which I'll get to. Let's create that first. In order to create the ATR study, here's my ATR in technical analysis. I just connect the two. And I was looking at a 5-period ATR, so I'll change the periods to 5. And I also want to look at a moving average of this. So in order to do this, I can just highlight this. I just dragged my mouse cursor. Right? I can right-click, copy, and paste. And now I can grab a simple moving average. Right? Let's find this here. Technical analysis has a simple moving average, and all of these averages are kind of here under the technical analysis. So you can really tweak this using any kind of average that you see fit. Now on my chart, I used a 20-period moving average simply because symmetrically I'm using 20-period averaging for the Bollinger Bands. I would suggest that you keep these the same. I would suggest that, if you change this Bollinger Band, let's say up to 30 or drop it down to 10, that you would do the same thing here as well. But I'm going to use 20 for my comparison purposes. And what I'm going to say is I'm looking for, now here's the secret to this strategy and how I'm going to tune this. This is a consolidation breakout. And the word consolidation is very important. That's what gives you your edge. And what gives you the difference between, I was talking about those angles before in the trend lines. The consolidation is going to give you a way to find when an event is significant versus when an event is not significant. And the idea here is that the consolidation should precede the beginning of a large breakout in the up direction or a breakdown in the down direction. Now, this is a generalization, but you see that this kind of tends to happen a lot. And this is really where we're going to kind of take advantage of some of the things that the system can do. So here's a perfect example, right? You see this price action that begins last year in September. It's consolidating. When I look at this chart and I generalize, right, I just eye this up. What happens is the price movement, it chops along to the side, it consolidates. Then all of a sudden it picks a direction. The market decides where it wants to go. And this is something that traders, swing traders and day traders have been recognizing for years, that this does tend to happen in price action. There's all kinds of philosophies about why the markets move the way they do and why economies do the things they do, etc., etc. But one of the small things that still to this day tends to happen is that when there's uncertainty about whether or not the stock should go in one direction or in the other direction, and this is also tied to the broad market, but when this happens, there tends to be a relative period of indecision. And then when a direction is picked, that's when everybody gets in the game. That's when all the funds decide to invest or to move big money, or that's when the public jumps onto a stock, like all the hype that it was, on say like a Netflix, for example, when everybody was getting excited about it because of the things that they were doing as a company, because of their expansions, because of their infrastructure, etc. The public kind of gets on board, and that affects the price action, right? And usually it's going to be in one direction or the other depending on what's going on. Well, what tends to happen is this period of consolidation tends to happen, and you can measure this with the ATR. Actually, you can measure this with any volatility study. Take a look at this 5-period average true range. Now, you will want to tweak this to, to taste, to however you like looking at this data. I'm looking at a very short-term ATR, but you might want to expand this. What happens is this orange line oscillates around its moving average. That allows me to make a relative decision, and I'm going to say, well, it's below its normal range of volatility, or it's above its normal range of volatility. And watch what happens here. This is probably the final bar when it's really consolidating, this bar right here on 930. Maybe these two would be considered, the 1st of October, the 4th of October. But what happens is, you see I get a cross right here. This orange line crosses over its average. I'm not going to use a cross, but I'm going to use that information in part of my strategy. During this period, you see how far below its moving average this orange line was. That's when the consolidation is happening. When you get these differences, it gives you a rule of thumb as to what's going on. And, it depends on the degree to how you want to analyze this, but I could do all kinds of stuff here. I could put a Bollinger Band on top of this, right? I could do the same thing that I'm doing up here down here. I could do that in Wizard Lab, but I'm going to keep it simple, right? I'm going to compare the average true range versus its average. And so in order to do that, I'm going to give myself a little bit of play, right? So for example, what happens now when it starts to break out, you see what happens? It jumps up above its volatility, and you see this ATR of 0.89, that's above its 0.80. So it becomes more volatile by definition as the breakout happens. It has to, otherwise you wouldn't have a breakout, right? So the volatility becomes manifest in the breakout. The bars are going to get big. Back on this date, see how big this green bar was compared to these bars? I could actually zoom in. You see how big this green bar is? Well, what happens is this ATR at the bottom here, this ATR jumps way out above its average. And you can use this information in making your decisions. But I'm going to do this, right? In my rule builder, I want it to be consolidating and then break out. That's what I want. I want it to be consolidating and then breaking out. So to define consolidation, I'll go into my logical operators, and I'm going to use a less than. Now here's the reasoning. I want to know when the ATR is below its 20-period average. I want to know when, and let me go back to my nice and clean example. I want to know when this orange line is below the red line. The orange line is the ATR, the red line is the SMA, the simple moving average of the ATR. But I have kind of a chicken and an egg situation, right? Because when the breakout happens, it's going to be above it. So in order to handle this in a very clean and elegant fashion, I'm going to use a logical study, which I don't often get a chance to use, but it's extremely useful, right? And so here's the little secret. Occurs within. The occurs within study is a very, very, very interesting study. And I'm going to rearrange these so you can see this. Occurs within. Now the definition, it's very blunt, right? But it says it returns a true value. That's a true logical signal. If a signal has occurred in the input study within the last number of periods. So in other words, what it's saying is the occurs within is going to give me a window of opportunity. Right? Now, let me define this. I'm actually going to use 3 periods. Let me show you what that looks like. If I use the occurs within, it acts as a filtering window. And it will scan the last 3 bars for a signal. So if I'm going to draw this on a chart, let's say I'm picking on this bar, for example. Right, where let's suppose I didn't get signals here even though I did. Let's say I didn't, and let's say the signal didn't come to this bar. Well, I would have missed that signal because the price action has manifested itself in volatility. Well, I want to avoid that. I want those signals. It was below its range and now it just broke out above it. So what I'm going to get is something that looks like this. I can actually draw vertical lines here. And if I draw a vertical line at this bar, and this occurs within, includes the current period, if I count 1, 2, 3 periods backwards, I have a window of opportunity, and it's saying if the price action was warranting itself to be volatile below its average within that window, I'm going to still give a signal. So this is kind of smart, right? This is kind of difficult if you're programming a script. This is very difficult to do, but in Wizard Lab it's a simple matter of dragging out a single study onto the canvas. I'm creating a window of opportunity, and as long as the orange line was below the red line at any point during that window, it's going to be valid, and it's still going to give me a signal. And you could see how I could change this, right? If I used, let's say, 6 periods instead of 3, right? I could move this, and I could move this over 1, 2, 3 more periods. That, and let me try to lock this down here. That would be the window if I changed that occurs within parameter from 3 to 6. If I did that, I would expand the window. Right? So for now, I just want to keep it a little bit tight. But you can tweak this by just changing this 3 to 6, etc. This is very useful for looking at past events. Right? Occurs within, think of it as a window of opportunity. So I'm going to say if this cross above happens, right, that'll give me a signal, one of these true-false signals. And I'm asking it a question. I'm saying, did this happen in this window of opportunity? This thing is also going to give me a yes or a no signal. I can tie these together with an AND study. I alluded to this before. And I can just ask the question, well, both of these things have to be happening. And if both of those things are happening, I can end it in a signal. And that is the strategy. Now, I mentioned before, you're going to want to turn forming bar on for this strategy. Forming bar is something that it evaluates the bars before they actually close. So this strategy, it's kind of simple enough that your trigger is really caused by a high price. And so this high price, you really want to look at the movement of the daily bar as it happens during the day. And you can do this by using the forming bar parameter. Let me zoom out and show you what that looks like. Right, so here's the big view. Now it's kind of scrunched up. I have a low resolution for this broadcast so that we can kind of reach out to as many people as possible. But if I tighten this up, right, and kind of it'll let you see this a little bit better. Right, I tighten that up a little bit, and I can actually shrink this. I hit all of those components as you see them. Now I'm going to move this back because my window was really 3 periods. Right, we'll lock that down. So everything that you see here on the chart is what we built in our Wizard Lab rule. And what we're going to do is, this is the buy side rule. I'm going to save this, and I'm going to give it a name which is called consolidation. I'm just going to abbreviate consolidation breakout, right? Which I'm going to give myself a hint that it's for long. Right? Now this rule is going to be, it's going to give me signals when it crosses above, and it's important to keep that rule separate from the signals that cross below, because every time I save these rules, they're saved under the My Rules toolbox, and I can reuse this in, kind of a master rule. I could create bigger rules that build on top of rules that I had already built. And here's my toolbox for all of the rules that I had developed, and I saved this strategy. It's available if I wanted to reuse this in another rule. Well, if I want to create the short side equivalent, my volatility measurement is going to be identical. The only thing that's going to change is that I'm going to look at the low price crossing below the lower band. Right? So I'm just going to change those adapters out by taking the low price, and I'm going to look for cross below instead of cross above. and I'm going to use the lower band instead of the upper band. And this is just, I'm going kind of fast, just a simple matter of changing the adapters. That's all it is. And now I've got the equivalent for the short side. And that's all it took to do that. I'm going to want to hit Save As here. Right? Save and Save As, there's a difference. Save As is going to create a brand new rule. I'm going to call this Breakdown. And I've got two different rules. Right? If I just hit Save, it would have overwritten my old rule. So I've got Consolidation Breakdown for short, Consolidation Breakout for long. And I'm going to build a strategy based on, I'm going to build two strategies based on both of these actually. And I'm going to go down into consolidation. I'll start with the long side. And these kind of plays, it's really good to have a trailing stop on these kind of plays. I'm going fast here too. Strategy Builder, for those of you who haven't seen this before, all you do is you take the rules, the scanning and the management rules that you built, and you create a strategy which says, what do I do when my rule fires? And all I'm saying here is that, well, keep scanning for consolidation breakouts. When that happens, send a buy signal. And if this is going into trade optics, it's just going to give me a signal which says, okay, well, this is a green buy signal. And you can look at the chart and see if you like that signal. If you like it, the order entry is pre-populated, and then you can just quite simply trade it right off of that. Now the close position side, you can put a trailing stop order on. And this is only going to be relevant to RTS trading, to real-time trading, because if it places a position, if it enters a trade, it will automatically place a trailing stop to protect that position. And I'm going to give this, say, a 1% offset. And it's usually good, I'll tell you right now, it's usually good to put a target on these breakouts as well. If you are up on a position by 3%, you probably at least want to liquidate half of it. I mean, this all depends on your trading strategy, but capturing profits can be just as important as protecting yourself with stops, because you always want to balance everything out so that in the end you've made money at the end of the day. You know, these moves, they may last for a long time. They're not going to move forever. So you always want to consider targets as well as stops in your strategy. And I'll just save this as consolidation breakout, for long. And what I'll do before I create the short strategy is I'm going to run a quick back test. And my goal in back testing for the very first point, right, is that I want to make sure that my signals make sense, that they're doing something which is logical, that the rules that I have don't have any mistakes in them, etc. So when I run my first backtest, I usually put it in raw mode backtest. And we'll run it on the S&P 100 for a week. And I'm just going to, maybe I'll bring that back to a little bit more because it's going off dailies. So we'll run it for the past 2 months. I'm going to run this. Right? Remember, I'm just looking for signals at this point. I'm going to run this, and while that's running, I'm going to go back and I'm going to make my consolidation breakdown strategy. Right? So I'm going to remove the consolidation breakout rule. I'm going to put in the consolidation breakout. I want to make sure that I change this side to sell, right? Because it should be shorting these positions or giving me sell servers. I'm sorry, giving me sell signals. Sell signals. Let's save this as consolidation breakdown short. All right, so now I've got a sell strategy. Right, and this backtest ran. It didn't find any signals during that time period. So I want to make sure. Well, number one, I want to make sure that my rule is set up correctly. Let me find this consolidation breakout. Right. Now, what have I got going on here? I've got the daily high crossing above the upper Bollinger Band EMA, right? And the 5-period ATR is less than its 20-period moving average occurring within 3 periods. So when this happens to me, I usually want to loosen up my parameters because I might have been looking for conditions that happened a long time ago, and maybe they didn't happen in the past week or so. Let me change this back to 6, and let me just make sure that this isn't checking for anything that it doesn't want to be checking, etc., etc. Run that again, see what happens. Make sure it's on raw mode backtest. This is actually finding the consolidation breakdown. And actually, now that I'm thinking about it, what's been happening in the market lately? Things have been going down, haven't they? So you see here I just got 41 results for the breakdown. I didn't get any results for the breakout because not too many things have been breaking out lately. I mean, that I find that to be believable. And a lot of these positions looks like they got out right away. So when this happens, when your positions get out right away, you usually have an error in the strategy builder. Right? My error is that I did not specify a % offset for the short side. Right? So I'm actually going to save this. Right? And we could run that again, but I just want to take a look at the signals really quick. Let me chart, say, a plot on Citigroup here. And here's a pretty good example of something where the system itself identified the breakdown condition. Oh yeah, we could run this on XOM just by itself actually. Let me talk about this really quick. What happened was it found that it said this was a period where the consolidation was enough, and then it found the breakdown on Citigroup here. Now this is very interesting, right? Because this just happened. According to this strategy, it's indicative that this trend could possibly continue. Right? So that's very interesting. And as you scan the results of the backtest, this is what you want to pay close attention to. You want to look at how your signals are coming in, because based on the results, I might want to tweak my parameters so that it does things a little bit differently. I may want to add more conditions that take more things into consideration. Let's run this on XOM. And let's do this over a longer period of time. Under symbols, right, I can run XOM, and I can actually run this over a long period of time. Let me go back to, let's say, a couple months ago. Let me make sure that this runs. That might be too long of a range, actually. Right now, we have to do these in 6-month windows. We changed this recently. That's coming on the next release. It has the change in the filter. And so in the past 6 months, it gave me a signal here. Right? Now let's take a look at this signal. Okay, so here's a situation where this actually triggered based on that thing that I was trying to filter out. Right? So it's an example of something that I want to filter. Right? Now it should be finding this signal right here. That's the one that we want to find. And actually, you know what I did? I was tweaking this a little bit. Let me change this. I had turned for consolidation breakout. Well, this is breakout. Let me save that. And let me make sure my curves within is 3 periods back. Right, let's open up consolidation breakdown. And let's tweak this a little bit. So I really don't like this signal. I want to get these signals more than I get these kinds of signals. So what's happening is on this bar, within the past, say, 3 periods, it is finding a situation where it was below. Well, perhaps my ATR is too tight. Right? Let me just change this ATR parameter, and let me try to tweak this to something that matches the realistic price action a little bit more closely. Well, I've got a 10-period ATR, and I'm still comparing this against a 20-period moving average. Right? So let's apply some intelligence here. You can actually create a band around this. Right? So how about let's do this. Instead of being so tight, let me make sure that the consolidation was within a threshold. And we're going to check this here. 1.18, 1.32. I'm going to give myself a 90 to 95% threshold. Let's do this. I'm going to use a scalar study. So let's go into the math operators really quick and scroll down to a scale. In order to give this moving average a threshold and to make sure that the price breaches that threshold, I can scale it by, say, 0.95. I can just toss this right in here. This is why you always want to run your back tests to start in raw mode, because you can manipulate the quality of your signals according to the back test. Now it looks like this wasn't enough to change anything actually. So I perhaps would have to tweak this a little bit more. But this is the main idea behind the strategy. You can scan for breakouts or breakdowns based on breaching the Bollinger Bands. And you can use the volatility in order to make a decision. Now I probably, let's see, I would like to get this to show up, but it looks like I'm not taking enough into consideration. Let me do this. Let me do this actually. Let me change it to 90% and let me widen my curves within. Let me save that and try that. So you see this procedure, this process of me going back and tweaking my strategies, right? This is what you can keep doing. And of course, all of these strategies, these are always available out on the web. You know, every time we build these in chat, you know, we always try to put these up. And well, you know, it looks like I need to do a little bit more work on this, right? But hopefully you get the idea of how you can tweak this so that you can combine all these ideas together and create a system that can really easily scan for the breakouts and the breakdowns, etc. So what I would suggest is take this strategy, right? See if you can play around with this volatility condition. Right? A lot of you guys in here who've been using the system for quite a while, you've gotten very good at being able to tweak and change these. Play around with this consolidation. See if you can improve on what I've done here and be able to create a system that manages these in the right way. So, you know, that said, there's a lot of stuff that you can do with this system. Sometimes there's many things that you can do with this system. So I just built this strategy today. Unfortunately, I don't have the volatility parameters tweaked the way I like them. I'll probably get back to you next week with a little bit tweaked parameters that have this kind of working the right way. But that's how you build the system in Wizard Lab. It's that simple, right? Really, what I was scaling was I was scaling this moving average. I was dropping it down by 5%. Oh yeah, definitely. If you guys can fix this for the consolidation, yeah, you definitely get like gold stars. You know, I used to get gold stars in kindergarten, but then they stopped giving them to me in first grade. They stopped giving them to everybody, unfortunately. Okay, so we're going to work on this consolidation part a little bit more, and we're going to get you guys an answer for this. Okay, that said, I'm going to wrap up today's chat today. Look forward to the things that we're doing with Prodigio. We're creating scanning systems that are going to be encompassing of pretty much more than anything that's out there, actually. Join us on the web, www.prodigiorts.net. Follow us on Twitter, and check in with us on these chats every Wednesday at 12 o'clock Eastern Standard Time, 11 o'clock Central Standard Time. We go over strategy, we talk about the system, talk about, you know, upcoming things, etc., and maybe try to give you some ideas or advice. And if you have proofs of Fermat's last theorem, I would appreciate you emailing them in so that, you know, I can erase your name and put my name on it. I'm just kidding, I would never do that. Okay, that said, hope you guys had a good time with today's chat. You know, I'll see you all again next week. You know, as always, this is it's been an interesting one, and we'll talk to you again very soon. All right, I'm going to sign off now. Goodbye, everybody. Have a great trading week, and take care.